Beginning with Wall Street, that ended this week with mixed results as investors assess trade developments and inflation data. The S&P 500 was little changed on Friday. The Nasdaq Composite rose marginally. Despite Friday's pause, all three major indexes finished the week higher, driven by greater clarity on U.S. trade policy and cooling inflation indicators. The S&P 500 gained 1.5% for the week, the Dow advanced 0.6%, and the Nasdaq climbed 2.6%. Investors brushed off a sharper than expected 0.9% decline in January retail sales market, were also buoyed by expectations that inflation may not accelerate, with producer and consumer price data suggesting a softer outlook for the Federal Reserve's preferred inflation gauges. In Europe, stocks pulled back from record highs on Friday. The pan-European stocks 600 ended 0.24% lower on Friday, snapping a four-session winning streak. Still, the index marked its eighth consecutive week of gains, rising around 9% so far in 2025. European markets have been reacting to corporate earnings and optimism surrounding potential peace talks between Russia and Ukraine. In Asia, markets were mixed on Friday. Japan's Nikkei 225 edged higher, maintaining its strong rally, while China's CSI 300 slipped as concerns over economic growth persisted. Investors remain focused on global trade tensions and the impact of U.S. tariff policies on Asian exporters. Crude oil prices dipped slightly on Friday as prospects for a Russia-Ukraine peace deal raised hopes for an easing of sanctions on Moscow. Now, this could stabilize global energy supplies. Brent crude settled at $74.74 a barrel. Both Brent and U.S. oil contracts still posted weekly gains of about 1%. Gold retreated over 1% on Friday due to profit-taking, but recorded a seventh straight weekly rise. Gold hit a record high of $2,942.70 earlier in the week. Safe haven demand remains strong and trade uncertainties and inflationary pressures. All right, for more on this, we are now being joined by Amrish Baliga. He is a market analyst from Mumbai. Thank you so much for joining us this morning.
Thank you.
Let me begin by asking you, what do you make of the volatility in global markets this past week?
See, I think one of the major reasons for volatility across global markets is President Trump and his policies, as markets are trying to adjust themselves to the new normal. The earnings in India have mostly been disappointing, leading to a further lack of confidence. And again, because of that, we have also seen that FIIs have been continuous sellers in India. But again, last week, if you see during the run-up to the meeting of PM Modi with President Trump, there were hopes of some major announcements. And that's why the markets rallied initially. But then post the meeting, again, we saw a decent correction. So even going ahead, I expect this volatility to continue at least for the next few weeks.
Right, you talked of Indian markets. Do you think the sell-off may have bottomed out?
No, I don't think so. Because we have some more downside for the markets. Because, see, many new investors in the market in the last 3 or 4 years, I think they are witnessing a major correction for the first time. Because they were a confident lot earlier, assuming that every correction is a buying opportunity. And they were proven right most of the times. But this correction, I think, has unnerved many of them. So, their profits for the last, 12 to 15 months or more must have disappeared in the last 3 months. So we can sense some amount of panic among these retail investors as positions are getting squared off, especially in the margin funding side of the market. So we can say that the markets have bottomed out only when there is capitulation and the markets have moved up 7 or 8% from their lows, which has not happened as of now. So I still see a further downside.
Right. And that being said, what according to you, are the key risks going forward for Indian markets?
See, the key risks, I would say, FII's continued selling, I think is a key risk even going forward. Though their Indian equity holding has come down to 16%, it was 20% in the last decade. Now it has come down to 16%. But they still continue to hold about $800 billion of Indian equity. I think the other risk is the Indian rupee itself, which has suddenly become weak. compared to US dollar. Unless that stabilizes, we really can't expect fresh inflows to come in. And the weak rupee will also have an adverse effect on the inflation, which will again have a domino effect. And also a further slowdown in the economy also is a risk which can't be wished away. Although it's expected that infra and the capex spend by the government should actually kickstart the economy going ahead.
Right. Now, just before I let you go, do you have a downside target for the Nifty and the Sensex?
Yeah, for the Nifty, I have a downside target of over 22,000. But you can't say that that could be the bottom. It can even go lower depending on the situation at that point of time. But however, I would say that it's a good time to deploy fresh funds, especially in that band of 22,000 to 22,500, when the valuation of the index itself becomes decent. But many of the stocks could actually be at very attractive levels. But one should always keep in mind that it's next to impossible to buy at the bottom. So one has to start buying when the valuations become attractive, though technically there can be more downside risk.
Right. All right. Well, thank you so much for joining us and giving all the updates on markets.